Let's be real. $1 million isn't rich anymore. But it is life-changing. Not because you're suddenly buying Lambos, but because it flicks your whole position in the world. Bills stop feeling like threats. Emergencies stop becoming disasters. You stop making every decision based on fear. So I want to show you what $1 million would actually change for you. In plain English, the wins, the traps, and the simple math that turns "I'll never get there" into "okay, that's actually buildable." Here's how we're going to run this. First, you're going to translate that million into what it actually does for you in plain annual dollar. Then we'll talk about the 2 or 3 things that can quietly wreck a 7-figure portfolio even if you're invested. And finally, you'll see how $1 million changes your options around work, time, and stress without pretending you never have problems again. So let's make the million feel real. A 1% move on $1 million is $10,000. That means a normal market day can swing more than a lot of people's monthly paycheck. A 10% year, up or down, is $100,000. That's why it feels intense. The numbers got loud. Now the fun part. If your portfolio averages 7% in a typical year, that's about $70,000 of growth. Not guaranteed, not smooth, but that's the math. Even 4% is $40,000. That's the moment you realize your money can earn more than you can save. And that's the first big shift. Saving stops being the main character. It still matters, a want. But the portfolio's behavior starts driving the story. When you're building, you can outwork mistakes. At $1 million, mistakes get expensive fast. A lot of people hit $1 million and think they should feel rich. Then they look at their lives and go, wait, why do I still feel normal? Because $1 million invested isn't a private jet. It's a foundation. It's a shock absorber. It's buying you the ability to not panic. If your household spends $6,000 a month, that's $72,000 a year. A common financial independence benchmark is roughly 25 times your yearly spending. For $72,000, that's about $1.8 million. So $1 million isn't always "I'm done." It's "I'm dangerous." And the word dangerous matters here. You've got enough money that a good year can change your life, and a bad decision can too. That's why the rules feel different. So let's talk about what life actually changes at $1 million invested. As your brain starts doing new math, even when you're not trying. You walk past a car dealership, and instead of thinking, "Can I afford the payment? That's $900 a month, which is $10,800 a year, which is like a permanent 1% drag on my portfolio if I keep spending like that." Once you've got $1 million invested, you're basically managing a small money machine. And money machines don't like drama. They like consistency, low friction, and time. So here's the first reality check that makes everything else quick. You don't have $1 million. You have $1 million portfolio with a personality. It has volatility. It has tax consequences. It has good years and ugly years. And your job is to keep it compounding while you're living an actual life. Let's turn this into a simple scorecard you can use without staring at charts all day. If you spend $50,000 a year, $1 million is 20 times that. If you spend $80,000 a year, $1 million is 12.5 times that. Same portfolio, totally different level of freedom. That's why 2 people can both have $1 million invested and feel completely different. One feels like they can breathe, the other feels like they're still grinding. It's not the number. It's the gap between what you spend and what the portfolio can safely support. Yes, safety matters, because the market doesn't pay you in a straight line. This is where people messed up with the famous 4% rule. They hear 4% and think, cool, I'll just take $40,000 a year forever. The better way to think about it is this. 4% was a historical starting point for a long retirement, and your real number depends on your timeline, flexibility, and whether you're still earning. Once you've got $1 million invested, you're basically managing a small money machine. And money machines don't like drama. They like consistency, low friction, and time. So here's the first reality check that makes everything else click. You don't have $1 million. You have $1 million portfolio with a personality. It has volatility. It has tax consequences. It has good years and ugly years. And your job is to keep it compounding while you're living an actual life. Let's turn this into a simple scorecard you can use without staring at charts all day. Start with your annual spending. If you spend $50,000 a year, $1 million is 20 times that. If you spend $80,000 a year, $1 million is 12.5 times that. Same portfolio, totally different level of freedom. That's why two people can both have $1 million invested and feel completely different. One feels like they can breathe, the other feels like they're still grinding. It's not the number, it's the gap between what you spend and what the portfolio can safely support. And yes, safely matters, because the market doesn't pay you in a straight line. This is where people mess up with the famous 4% rule. They hear 4% and think, cool, I'll just take $40,000 a year forever. The better way to think about it is this: 4% was a historical starting point for a long retirement, not a promise. And your real number depends on your timeline, flexibility, and whether you're still earning. If you're still working and you just want the pressure off, $1 million can be a coast button. If you're trying to fully replace income tomorrow, $1 million might not be enough yet, depending on your lifestyle. Here's a clean way to feel it. Take your yearly spending and divide your portfolio by it. That's your years of spending number. $1,060,000 of spending equals about 16.7 years. $1,100,000 of spending equals 10 years. Seeing that ratio is grounding. This week, open your Notes app and write two numbers, your annual spending and your invested total. Then, divide the total by spending and write the result as a single sentence. My portfolio equals years of my current lifestyle. Don't judge it, just get the truth. Now, the next change at $1 million is subtle but huge. The cost of being sloppy gets measurable. At $50,000 invested, a 1% fee feels invisible. At $1 million, a 1% fee is $10,000 every single year. Not once, every year. That's a car payment you never drove. Same thing with taxes. If you're constantly selling and triggering gains, or you're ignoring where your investments sit, you can create a silent leak that's way bigger than your streaming subscriptions ever were. So one common mistake at $1 million is acting like you're still in the scrappy builder phase, obsessing over tiny spending cuts while a massive leak sits inside your investing setup. Another common mistake is the opposite. People see seven figures and get bored. They start swinging at shiny stuff because they've earned the right. That's where concentrated bets show up. Crypto side quests, options plays, private deals from a friend of a friend. And suddenly your portfolio's risk profile looks like a meme stock chart. Here's the myth. I've got $1 million, so I can afford to take big risks now. Here's the reality. When you've already won a life-changing amount, the smartest move usually isn't taking bigger risks. It's taking smarter risks. There's a difference between growth and gambling. Do the math with me. If you blow 40% of a $1 million portfolio, you're down to $600,000. To get back to $1 million from there, you don't need 40%. You need about 66.7% growth. That's the part people don't emotionally register until it happens. So the job becomes, keep the upside, reduce the chance of permanent damage. That doesn't mean you hide in cash either. Cash feels safe, but it has its own risk. It quietly loses buying power, and it can make you miss the years that do the heavy lifting. A lot of seven-figure investors learn this the hard way. They sit out after a scary year, waiting for certainty. Then the market runs without them, and the opportunity cost is enormous. Missing a 20% rebound on $1 million is $200,000 you never get back. So what's the better approach? Boring, diversified exposure that you can actually stick with, plus guardrails that keep you from selling at the worst time. Think of your portfolio like an engine. You don't floor it with the hood open. You keep it maintained, you keep it fueled, and you don't yank parts out because you heard a weird noise. One of the most underrated guardrails is simply having a cash buffer that matches your real life. Not because cash is a great investment, but because it stops you from turning market volatility into a personal emergency. If you're working, maybe you keep 3 to 6 months of expenses in cash. If your income is irregular, maybe it's closer to 6 to 12 months. If you're near a big transition, cash buys you time to make decisions with a calm brain. Here's what changes at $1 million. Your buffer isn't about emergencies. It's about not forcing sales. If you're pulling from your portfolio for lifestyle, sequence risk becomes the villain. That's a fancy way of saying this. Taking money out during a bad market can permanently dent compounding. A 25% drop plus withdrawals can turn a temporary dip into a long recovery. So instead of trying to predict the market, you build around it. A clean setup a lot of people can live with is a simple split: long-term growth money that you leave alone, and short-term spending money that keeps your life stable. The exact percentages vary, but the concept stays the same. Now let's talk about the next shift. Your relationship with work changes, even if you don't quit. $1 million invested doesn't always mean you're financially independent, but it often means you're no longer financially fragile. And that's a superpower. You can negotiate harder. You can say no to the project that's wrecking your weekends. You can walk away from a toxic manager without feeling like your life will collapse. That kind of optionality is the real flex. And it's worth a lot more than the stuff people usually buy when they hit a milestone. This is where lifestyle creep gets sneaky. You hit $1 million and you think you're allowed to upgrade everything at once. New car, bigger place, nicer trips, premium, everything, and your spending jumps 30% without you even realizing it. Then you look up and your years of spending ratio got worse, even though your portfolio hit 7 figures. That's such a common faceplant at this stage, because it's not that you bought something, it's that you permanently raised the floor. So here's a better approach. Decide what you actually want to upgrade and keep the rest boring. If your spending goes from $60,000 a year to $90,000 a year, you just increased your 25 times target from $1.5 million to $2.25 million. That's a $750,000 lifestyle decision, hiding inside a few upgrades. That's not a moral judgment, that's just math. Now, I'm going to say one sentence that's annoying, but important. Some years the market's going to punch you in the mouth, and that's normal. Okay, with that out of the way, let's get tactical about protecting $1 million without turning into a nervous wreck. First, fees. If you've got money in high-fee funds or you're paying an advisor 1% for basic stuff, you've got to at least run the comparison. Because $10,000 a year in fees over 20 years isn't just $200,000. It's the lost compounding on all those dollars too. Depending on returns, that gap can grow into the mid-6 figures or more. Second, concentration. $1 million often builds from one thing going really right. A job stock plan, a single company, real estate in one city, crypto, whatever it is, it can create a hidden single point of failure. If 50% of your net worth rides on one stock, that's not confidence, that's exposure. I'm not saying you have to sell everything and become vanilla. I'm saying you should know your percentages and you should pick them on purpose. Because when the numbers are big, I didn't realize is an expensive sentence. Third, your investing behavior. The biggest threat to $1 million isn't usually the market, it's you reacting. If you're checking daily and feeling your mood change with the chart, that's a sign you're overexposed for your actual tolerance, or you don't have enough buffer, or your plan isn't written down. This week, write a simple investing rule for yourself in one paragraph. Something like, I'm invested for the next 10+ years. I'm diversified, I contribute automatically, and I only rebalance on a schedule, not based on headlines. Then save it where you'll actually see it when you're tempted to panic. Now taxes, without turning this into a boring lecture. At $1 million, taxes start mattering because small percentage improvements are real money. A 0.5% improvement on $1 million is $5,000 a year. A 1% improvement is $10,000 a year. That's why people with big portfolios obsess over tiny percentages. It's not because they're weird, it's because the math finally pays. So if you're still randomly buying and selling in taxable accounts, or you're ignoring capital gains, you're making life harder than it needs to be. Even something simple like not churning your portfolio can help. Long-term gains are usually taxed differently than short-term. The less you thrash, the less you leak. Also, asset location matters. If you've got retirement accounts and taxable accounts, which investments sit, where can change how much you keep after taxes over time. You don't need to be a wizard, but you should at least understand the basics so you're not accidentally building a tax bill. Now let's bring this back to what you actually feel day to day. At $1 million invested, you start noticing that risk isn't just volatility. Risk is also overcommitting your life. You can have $1 million invested and still feel trapped if your fixed costs are high and your schedule is maxed out. Freedom comes from flexibility. Flexibility comes from margin. So one of the best things you can do at this stage is build a spending policy that matches your values. Not a budget like you're broke, a spending policy like you're the CEO of your own life. For example, you might decide you'll spend aggressively on 3 things that actually improve your life, and you'll keep everything else default. And when you're tempted to inflate your lifestyle, you run the portfolio math instead of the emotion. If I add $1,000 a month of permanent spending, that's $12,000 a year. At 25 times, that's like adding $300,000 to my independence number. That one calculation can save you from a decade of regret. Now, what does $1 million change about your work decisions? It gives you a new menu, not infinite, but bigger. If you like your job, great. $1 million can turn your career into something you do because you want to, not because you're terrified. If you don't like your job, $1 million can buy you time to pivot without wrecking your life. This is where the decision tree gets useful. If you're still accumulating and you want to hit $2 million or $3 million, the play is usually boring. Keep investing, keep your lifestyle stable, and focus on the one lever that still scales fast, which is income. If you're more burned out and you want relief, the play is different. You protect the downside, you reduce fixed costs, and you create a runway for a change that might not pay immediately. If you're close to using the portfolio to support spending, the play shifts again. You get serious about withdrawal behavior, you keep a larger buffer, and you stop treating your portfolio like a casino. Same million, different intention. Let's run 2 quick examples so you can see how this looks in real life. Example 1. You're 38, you've got $1 million invested, and your household spends $70,000 a year. You're not fully done by your hire, but you've got a huge advantage. If you keep working and invest $2,000 a month, that's $24,000 a year added. If the portfolio averages 7%, that's roughly $70,000 in growth in a typical year, plus your $24,000 contribution. That's about $94,000 of movement before taxes and volatility. Now your job isn't dragging you to freedom, it's accelerating you. Example 2. You're 45, you've got $1 million invested, and you spend $90,000 a year because you've got high fixed costs. That portfolio might still feel tight, but even here, the million changes your leverage. If you can cut fixed costs by $1,500 a month, that's $18,000 a year. And 25 times, you just lowered your independence number by about $450,000. That's not saving money, that's buying years of your life back. That's the part people miss. The biggest wins at $1 million aren't always more return. Sometimes the biggest win is designing a life that needs less. And that doesn't mean you live like a monk. It means you stop paying full price for stuff you don't even care about. Now, there's a specific mistake I see a lot right after people hit 7 figures. They stop paying attention because they think they've arrived. They stop contributing. They let their accounts drift. They don't rebalance. They don't update beneficiaries. They don't even know their overall allocation anymore. And then 5 years later, they wonder why it didn't turn into real wealth. $1 million is a checkpoint, not a finish line. A better approach is to treat $1 million like the start of the compounding sweet spot, where the next decade can be wildly powerful if you just don't self-sabotage. Because at $1 million, time starts doing heavy lifting in a way you can actually feel. A single strong decade can be the difference between I'm comfortable and I'm truly free. If your portfolio compounds at 7% and you add nothing, $1 million can grow to about $1,967,000 in 10 years. That's not a promise, but it's a useful reference point. The point is, you're finally at the stage where the math can move faster than your effort. Now let's talk about how life changes in a way nobody puts in a calculator. Your stress baseline shifts. When your car breaks down, it's annoying, not catastrophic. When your company restructures, you're mad, not terrified. When a family emergency hits, you can take a breath and handle it without turning it into debt. That's what $1 million is really buying first, the end of panic. But only if you protect it from the dumb stuff. So what's the dumb stuff? Getting overconfident and concentrated, letting lifestyle explode, selling in fear, paying high fees because you never checked, treating the portfolio like a slot machine. And here's the hard truth. Most of those aren't financial problems. They're emotional problems wearing a finance costume. That's why writing down your plan matters. That's why buffers matter. That's why automation matters. Because your biggest enemy at $1 million is your future self on a bad day. Now, let's tighten this into something you can actually execute without turning money into your hobby. You need a simple system that does 3 jobs at once, keeps you diversified, keeps you invested through chaos, and gives you a clear way to spend without guilt. Diversified is obvious. Broad exposure so one company, one sector, or one trend can't nuke your life. Staying invested means you've got to build so you don't have to sell at the worst time. That's buffers and behavior. Spending without guilt means you've got to decide your enough lines, not for the internet, for you. And the best part, once you set those lines, you stop having the same argument in your head every week. Now let's talk about $1 million as a tool, not a trophy. A trophy sits on a shelf, a tool gets used. So what do you want to use it for? Maybe you want to buy back time. That might mean reducing hours, switching roles, or taking a sabbatical without blowing up your future. Maybe you want to take a career swing, like starting a business or going back to school. Maybe you want to help your family without becoming the family bank. Maybe you want to be able to say no and mean it. This is the real lifestyle upgrade, your calendar. If you use $1 million to inflate stuff, you'll feel the same. If you use $1 million to create margin, you'll feel the difference every day. This week, pick one freedom move and put it on the calendar. It could be updating your resume, having a conversation about reducing a fixed cost, or setting a meeting with HR about a role change. The point isn't to quit. The point is to act like you've got options, because you do. Now, if you're thinking, Andy, what if I'm at $1 million but it's mostly retirement accounts and I can't touch it yet? That's normal. And it still counts because it's still compounding. The way it changes your life today is by changing your negotiating power and your risk tolerance at work. You can make decisions from strength instead of scarcity, even if the money's earmarked for later. And if you've got $1 million split across retirement accounts, brokerage, and maybe a little cash, your job is just to keep the system clean. Keep contributing, keep fees low, keep risk reasonable, keep your spending from permanently ballooning. That's it. That's the secret. Not a new hot strategy, not a perfect entry point, not predicting the Fed. It's staying boring long enough for compounding to get unfair. So let's land this with a simple way to think about rules changing at $1 million. Before $1 million, you're mostly building with effort. Your savings rate, your income, your discipline, that's the engine. At $1 million, the portfolio becomes a second engine, and your job is to keep both engines running without doing something dramatic that blows a gasket. That means you stop trying to win every year. You stop confusing activity with progress. You stop treating volatility like an emergency. You start caring about percentages because percentages finally matter. And you start making lifestyle decisions like they have price tags measured in hundreds of thousands, because they do. If you've got $1 million invested, you've already done something most people never do. And you don't need a brand new personality to make it work. You just need a cleaner system and fewer unforced errors. Keep your ratio in mind, portfolio divided by annual spending. Keep the leaks small, fees, taxes, thrashing. Keep your behavior steady, buffers and rules beat vibes. And keep using the million for what it's best at, buying you choices. You're not done, but you're absolutely out of the fragile zone, and that's a huge win. Stay patient, stay intentional, and let the boring years stack up until the math starts feeling ridiculous. If you want more videos that break money down like this without the hype, subscribe.